Hello and welcome to Trading Hour. I am Reema Tendulkar. With me is Sumara Abdi and Pavitra Pare. Good morning, girls. In terms of the screen, it's really hard, right? It's been so choppy for our markets over the last couple of days. There's really been no direction, so to say. For the last 3 days, markets have drifted lower. Today as well, we had a bit of a gap up start. We tried to climb higher, but again, in the last 30 minutes or so, we've seen some selling. The mid-caps are under pressure. The mid-caps have been underperforming for the third day in a row. So week to date, if you map the performance, the Nifty is down 2%, while the mid-cap index is sold off close to about 3.2%. Banks too are flat right now, but again, off from the early session highs. But just take a look at markets like Hang Seng, right? Yeah. Where this whole chip issue and the semiconductor and all the tech stocks are bleeding. Hang Seng is down more than 7% in the last 3 trading sessions, closer to 7.5%. So again, keeping it in context, Indian markets are still faring better, though we have breached very close to that 200-day moving average. We're hovering around those levels.
Oh, absolutely. I mean, yeah, I think if you look at it in the broader context of Asia, we are still outperforming, but this has been quite a fall that we've seen. Even yesterday, with that last hour sell-off, we saw over 1.5% kind of fall, and today this is what's happening with our markets. The Nifty Bank also pretty close to the flat line right now. What's holding up in this market are some of the PSU stocks, so the likes of Power Grid, Coal India, NTPC holding up in this market. Some of the auto names also doing quite well, so Bajaj, M&M. Tech is having quite a mixed day. I mean, of course, yesterday the cuts were quite sharp after we did get the earnings, but right now if you see some of the tech stocks, these ones are holding up, but if you take a look at Wipro, Tech Mahindra, these ones have seen quite a slide in the past few minutes. So do keep that entire space on your radar. What is also very steady is Axis Bank. Today, of course, it's doing well, but in the past 5 days, this is the kind of move that you've seen on Axis Bank, 6.5% higher. On the downside, also some of the pharma names. And remember, this is an important week, and the next couple of days will sort of have a lot of cues coming in. So you have the US Fed minutes that will come through today. You have the US CPI tomorrow. You also have the Indian CPI figure, which will come through in the evening. And also we're tracking what's happening with crude prices, because of course there has been a fall, which does work well for India, but we're tracking that closely as well. So lots for us to watch, Sumera, ahead of all of these cues.
Hi, morning, girls. So let's get started and tell you all that we have lined up for you today. Key indices slip after opening in the green. Consumer durables, metals and pharma lead the slide. FMCG as well as oil and gas flash some green. Midcaps fare worse. To talk about the outlook for the market, we'll be joined by Dheeraj Sachdev of Roha Asset Managers a little bit later on the show.
As recession fears and global economic uncertainty takes center stage, we will be joined by Rabobank's Michael Every to discuss the impact on markets the world over, the inflation challenge and lots more.
Tech continues to be in focus with quarterly results of HCL Tech and Wipro due later today. We'll line up all the key expectations from both companies later on the show.
And from equities to some important macro data to track the inflation print for September, and industrial output data for the month of August are also expected later today. We will be joined by Indranil Pan, Chief Economist at Yes Bank, to discuss the key expectations. So all of this and lots more lined up for you over the next 60 minutes.
And let's begin our show by discussing what's happening on the global front and where we are headed. We're now joined by Michael Every, global strategist at Rabobank, on the show now. Michael, this has been a very tough market to call. There is still lack of clarity of how many more rate hikes, where the inflation is headed. Korea has hiked rates by 6 times. They started their rate hiking cycle in August of last year, but it's done little to bring down inflation. And that seems to be the story all over. Fed has done 5 rate hikes. What's the call now in the markets? How would you assess the risk reward, and where do you think we're headed?
Well, to be blunt, what you're saying is absolutely relevant, but it was a lot more relevant a couple of weeks ago when that was where the market discussion was sitting. Right now, in light of the news that we got from the Bank of England overnight Asian time, markets are in a whole different space, because the Bank of England, on top of the recent interventions that they've made to try and prop up bond markets and financial markets in general, on the back of the rate hikes that they've been pushing ahead with, have now come out and said, you've got 3 days to sort out all your imbalances and all your wonky trades and all your longs that should be short and shorts that should be long. And then we're stepping back from all market support. And from Monday, you're on your own. So you can expect some extreme volatility today, Thursday, Friday, and of course, going into next week, because either the UK has become an emerging market that doesn't know what it's doing, or rather the left hand doesn't know what the right hand is doing. And if it's going in that direction, everyone else will follow. Or they do know what they're doing, but what we're going to see is central banks continue to raise rates and not prop up financial markets at the same time, in which case all the volatility we've seen so far is just a warm-up.
All right.
So what would the call be, Michael?
Well, so overnight, as I said, the Bank of England
Yes.
governor said you've got 3 days and we're not stepping in again. And we already have the Financial Times headline this morning that privately, apparently other people in the bank have told the Financial Times that don't worry, if there is volatility, we will step back in again. So which one is it? Are they stopping these market interventions to try and say that's it, settle everything in 3 days and then you're on your own? Or are they going to continue to step in? The markets will, of course, test them, which means we will get volatility. And then we're going to find out whether or not the BOE and other central banks are prisoners of the pyramid scheme that markets have built on the back of low interest rates and too much liquidity from said central banks, or whether normality, what used to be normality, can ever reassert itself. So this is a wild, wild period with very, very high stakes poker being played by both sides.
All right. Hi, Michael. Good morning. I think wild describes it well. But, you know, as far as the U.S. is concerned, take us through what you're really penciling in for what could happen to the markets in the next couple of months. We did get the jobs data a few days ago. That looks very strong. It does not look like the Fed has any reason to sort of move away from this aggressive rate hike kind of, you know, the cycle that we're seeing. What do you think we could see in terms of a downside risk for the markets now? We had Jamie Dimon yesterday. He's saying another 20% on the S&P is a given.
Well, I don't make stock calls, but I have to say that particular one from Mr. Dimon sounds entirely reasonable. You know, he wasn't saying the same thing a year ago. What's lying in store for the Fed is very much what's lying in store for the Bank of England. I mean, the economy there is stronger. They don't have the same structural problems. They don't have the same degree of conflict, shall we say, between fiscal and monetary policy. But on a fundamental basis, you have a market which has been propped up by far too much liquidity and far too low interest rates for far too long. And you have a central bank which is also saying we're going to hike interest rates and keep doing it. The data have not turned anywhere near enough for them to stop doing that yet. And we're going to continue with QT, so drawing liquidity out of the market. And if that happens, you will see exactly the same crisis emerge that you're seeing emerge in the UK, where people who have gone leveraged long assets, which are now seeing the prices collapse because interest rates are rising, will start to fall over and collapse, and they will start to demand bailouts, because if I fail, they fail. If they fail, someone else fails. Then we have a systemic risk. And guess what? It's your job to stop that happening, which runs completely counter to what they're trying to do to fight inflation. So are we going to fight inflation, or are we going to bail out people who made really bad bets for far too long? That's basically what is about to be shown to the world one way or the other. And the implications for all of us couldn't be more important or larger, because if they go one way, inflation will come back and will remain in place. And if they go the other way, we will have low inflation, but we will have asset price deflation to match.
Michael, I should probably ask you what you make of Ben Bernanke winning the economics Nobel. But maybe we'll have that conversation offline. But what is the prudent move now for investors? You know, do you recommend that they should slowly start moving to cash? Because even if you move to cash, what do?
Well, cash has been the smart move for quite some time. And I will just slip in that Mr. Bernanke winning a Nobel Prize is you know, someone else should have won one for comedy for that.
Well, Ray Dalio did say cash is not trash right now. But Michael, wanted to get your thoughts in on India and how does it stand versus the rest?
Well, in terms of the financial market dynamic that I'm describing, there is no hiding place, because if you get all the major economies acting like emerging markets, which is what we're seeing, with extreme volatility, then no matter how sensible or pragmatic an emerging market is, you will still be buffeted by that storm. And obviously, India is not immune to that. But if you ask me from my longer term perspective, as you see G7 economies start to look more like emerging markets, the larger emerging markets are relatively looking much more attractive. And I don't think that's a short-term trade, not one that I would recommend anyway. But in the longer run, I think India's standing continues to improve and India's stock continues to rise.
All right. Michael, just one question on the move that we've seen on the dollar. It's currently close to 113. Do you think we're pretty much close to a peak now, or do you think there's still some room?
Well, let's put it like this. If the Fed are going to keep hiking and you see other central banks blinking or failing to keep pace with that, then we are more likely to see that index you're referring to at 115 and then maybe 120. So we're talking about maybe a 5 or 6% increase from where we are now, carried across to all major FX crosses.
Michael, pleasure having you here with us on CNBC-TV18. Sounds like a bit of a tug of war. Let's wait and see what happens with Bank of England and what they finally decide. And even in terms of Fed, are they going to be going by the requirements of the market or the economic data? Get into a break on that note. On the other side, we'll come back and discuss what's buzzing in commodities. Manisha Gupta joins us next.
Hi, welcome back. You're watching Trading Hour. Let's shift the focus now to the commodity markets. As always, Manisha is here to talk about the one commodity in focus today. Hi, Manisha. What are you tracking?
So, Mara, I'm looking at the rubber prices because we've seen a constant decline in this year into these, and the decline just got even more stronger on the weaker side. If you look at the global markets, we are trading at a 2-year lows in case of rubber prices, and the cues clearly coming in from China, where the COVID breakouts now and this time around in the big cities of Shanghai and Shenzhen really seem to be weighing on to the markets. The other data that the markets are reacting to is the automobile sales in China, which on year-on-year basis have seen a gain, but on a month-to-month basis have seen a decline coming in. That's weighing on to the markets there. In the Indian markets also, when you look at the April and August 22 numbers till now, the production has increased, but the consumption has been on the higher side as well. And we have seen imports and cheaper imports at that continue into the markets. So the street is looking at higher consumption this time around, and that should have been supportive. But at this point in time, the weak global cues and the fact that we also are looking at a peak tapping data, tapping numbers in the Indian markets also seem to be weighing in. The tapping in the Indian market starts from majorly October and goes until November, Feb as well. So major arrivals in the markets for rubber is what seems to be weighing on, and the stockists and the tire companies not buying as much rubber too. It actually is the tire manufacturing sector which accounts for nearly 71% of overall rubber consumption, and that is where we are looking at a weak demand coming in from. These are the numbers in last couple of years on what production has been, which has increased year on year, but the consumption has taken a major jump by nearly 12 to 15% on year-on-year basis. So going forward, that data is going to be important to watch out for. Take a look at the prices as well then, and that have continued to decline. If you look at those are the global prices, of course, which have continued to decline. Month on month, year on year, we have seen negative moves come in here. For the Indian markets, when you look at the month on month prices here, it was in the month of July that we were trading at around 170 rupees per kg. But take a look at August, September, October, the prices have continued to decline. So much so that the August, September and October prices actually trading within that 148 to 150 rupees per kg mark. We did see all-time highs of 238 rupees per kg back in 2011. From there, it has been a constant decline in prices, and it really seems to be holding at the lower side of the range right now in October.
All right, Manisha, thanks a lot for getting us that quick update on the rubber prices. For the markets, it is really shaky this morning, and we're currently just around 15 odd points in the green for the Nifty. And the bunch of the pain is also seen in the mid-cap space right now. So that'll come up for you around 0.5% gone on the mid-cap index. So let's do one thing. We'll get into a short break now, but when we come back, we're going to discuss the market technicals. Mitesh, welcome back. You're still tuned into Trading Hour on CNBC-TV18. And a key macro cue for us to track today is that India's inflation print for September is likely to stay elevated. It's likely to stay above the RBI's target band for yet another month. This would actually be the 9th straight month. Industrial output for August, meanwhile, is expected to have contracted. So my colleague Ritu is standing by, and she's lined up all of the key expectations for us. Ritu, it's over to you.
Well, thanks for that. Let me start with inflation, where consumer price inflation is seen touching a 5-month high of 7.32% for September, as per our poll, up from 7% the month before. Now, well, that is the median estimate. Forecasts range between 7 and 7.5%. Now, this is going to be the third straight quarter where inflation remains above RBI's target band of 4% plus minus 2%, which will mean RBI will have to explain its failure to meet the inflation target to the government under the MPC framework. The rise in inflation is expected to be on the back of a rise in food prices and a sticky core inflation. Now, erratic monsoons and supply shocks from the war in Ukraine do lend upside risks to food inflation. Monthly average retail prices of rice, wheat, tomato, etc. continue to rise sequentially, and to the extent the rupee weakens, there could be some pass-through effects to the CPI trajectory. Core inflation is seen at 6.13% as per our poll, which, if it materializes, will also be the highest in 5 months. A quick word on IIP as well, where industrial production growth is expected to remain sluggish for the month of August. It is seen at 1.8%, down from 2.4% in July. The estimates again range from 0.5 to 4.7%. Now, this will be on the back of a slightly higher base last year and a muted core sector growth, where, remember, core infrastructure industries grew by 3.3% in August, which in turn was led by muted electricity output.
Thank you very much for that. To discuss the key CPI and the IIP expectations, we're now joined by Indranil Pant, the chief economist at Yes Bank, on the show now. Indranil, the big narrative about India's macro is that there is relative comfort on our domestic macro versus the global uncertainty that we are going through. But in the last couple of days, we've seen the sharp depreciation in the rupee, which again was going to hurt our imports, which again will then flow through into inflationary expectation. What's the trajectory that you expect from India's CPI today as well as over the next 6 months, and the implications for future rate hikes?
We don't expect the CPI to come below the 6% level before February at least. And beyond that, I think what we are looking at is a relative cool out in the global commodity prices. And by that time, most of the ramifications of global monetary policy dynamics will be already in the price. So at that point in time, we are not expecting the currency to be as be on a depreciating bias as it is today. And there will be a better and a steadier trend in terms of global commodity prices and the sort of depreciation pressure for India. So all that taken together, we are expecting inflation to come down. Do also remember that we'll have a base effect for next year because of the higher inflation prints of the current year. So that also should be beneficial. So next year, broadly on an average basis, we could be looking at inflation at around 5.3, 5.4% levels, not anything below that. We do agree to the RBI's forecast of the Q1 broadly, which is about 5% at this point.
All right. Hi, Mr. Pant. Good morning, and thanks for joining us. So, take us through where you expect most of the pain to come through, and also on the core sector activity. Yes, we know it's expected to remain muted in, the figures today, but how much longer do you expect that this part will stay quite muted?
Well, on the production side, we have a much lower number than what you're expecting in terms of the consensus that you pointed out. We are at a 0.8%. The bigger shock for us is probably the manufacturing sector. And we do see some implication of the higher inflation prints to manifest and the higher monetary policy interest rates to manifest into slower demand growth going forward. The other print that we would be looking at, and this is quite relevant as we go ahead in our growth projections, the gross domestic savings is once again down from the household sector. If I look at it, it's down to 10.8%, which is even lower than the pre-pandemic level. Yes, to a certain extent, there will be normalization, but most of the pent-up demand that we had been talking about is now mostly done away with. And going forward, therefore, the private consumption demand will probably be relatively slow in terms of its movement. The other big enabler for growth that has been there was the government investments, but the pace of the capital outlay within the budget may not have a very significant upward bias in the budget, though the finance minister did point out that the budget will be growth oriented. But from a perspective of capital expenditure under the budget, we might not see a significant increase because of the fact that the government is already carrying a high debt GDP ratio. You had asked something on the inflation side also, I guess.
Okay, we'll come back to that point. Just wanted to get your thoughts in on the current account deficit. Rising current account deficit, Indranil, is a big worry. I think in the first quarter it was already at 2.8%. The fear is that it's going to cross 3%. And India's current account deficit has crossed 3% only in 2 instances, I think in 1991, and the other one was in the taper tantrum of 2013. What's the call now on current account deficit, and what are the implications for the Indian economy and what the RBI can do?
So for me, and this I believe for quite a significant period of time, the current account problem becomes a problem only when your capital account also is weak. And the 2 instances that you did point out that your current account had increased significantly, the capital flows because of the global dynamics were also weaker. Today, I think we see the same situation. Our expectation on the current account GDP for the current financial year is at a 3.8%. And given the fact that we continue to see weaker trends in terms of the global flows, not only because the liquidity is tightening globally, but also the very fact that the domestic interest rate. So if I compare the India's 10-year interest rate to the US 10-year interest rate, the gap is now very narrow. Doesn't even cover the pace of depreciation that one would be expecting on an annual average basis for the years going ahead. So those are some of the factors which will keep the capital flows muted. There is a significant amount of sort of hope that is coming or on the FDI side. But if the growth itself is lower, we will probably raise some questions in terms of the absorptive capacity for the economy in terms of sustaining the 35 to 40 billion in terms of the FDI. So yes, the balance of payments remains in a deficit for us.
Mr. Pan, just one final question. You were mentioning the manufacturing growth. Do you have any targets for that? If you could take us through that. And also with the erratic monsoon that we are seeing, across the country, what is your expectation on just the food inflation as well?
Yeah, so for this month, we are definitely expecting food inflation to go higher. The month-on-month pace that we are looking at is of 0.6%, which is lower than the last month, but significantly still remaining on the higher side. The typical factors in terms of the advanced numbers that we have, tomatoes is a thing which is sort of bounced up quite significantly. Given the fact that we have still sort of rainy conditions in certain parts of the country, one might actually continue to look at damage to paddy crops. So that's one factor that needs to be built in to the inflation prints going ahead. And also the vegetable crops. So this is a very crucial period for the vegetables, especially the tomatoes and the onions. So those are some of the factors that we should be looking forward to. The hope today is that the reservoir levels are good enough and therefore the Rabi should actually perform better, and that could actually provide a buffer to the agriculture segment within the GDP. On the manufacturing side, I did explain that we will be looking at a relatively lower sort of production because the visibility in terms of demand is not very strong. Private capex also doesn't seem to be picking up in a very significant way. And from a GDP perspective, the net trade is definitely negative. That's a drag on the GDP. So for the year, we are currently at a 6.9% in terms of the annual GDP print, which is slightly lower than most of the expectations on the street, even from an RBI perspective, or even from the bilateral agencies whose data we continue to track.
Indranil, pleasure having you with us. Thank you very much for joining in. Let's also invite Mitesh Thakkar to take stock of the market technicals as we move forward. Mitesh, morning, and thanks so much for joining in. There has been that bit of a recovery that we're seeing in the markets right now. So we're up 40 points on the Nifty. Any trade?
Yeah. Rima, good morning. So I think, I'm not very convinced with this bounce back, though I think the good thing is that we are holding just above the 200-day average. But if we yet to see any kind of reversal signals happening on the hourly and the 2-hourly chart, so I think just wait it out. For the time being, trade on stock specific basis. A good short trade will emerge if we start breaking below yesterday's low of 16,950. Then take a 60-point stop loss, play for targets of 16,750 or 16,780 zones, and otherwise, wait for some kind of reversal happening on the hourly charts before going along. So I think for the time being, the bias looks like that we might break yesterday's low and then explore a short if we start trading below 16,950. For the time being on the stock side, Axis Bank is a buy. That's one buy call from my side. Buy with a stop at about 790 for targets of 820. While on the short side is Asian Paints, which is given some kind of a negative breakdown on the charts. That's a sell. Keep a stop just about 32.80. Look for targets of 31.70 here.
Thank you very much for that. Get into a break. Up next, we'll discuss market fundamental. Dheeraj Sachdev of Roha Asset Managers joins us next. Welcome back. Let's talk about the markets and what it means for your money. Dheeraj Sachdev, the managing partner and CIO at Roha Asset Managers, is with us on the show now. Dheeraj, morning, and thanks so much for joining in. Well, a lot of people we've been speaking to are saying that this is the time to increase the allocation to cash because it's so hard to call this market and which direction it's going to go. So forget getting into levels and 5% upside or downside or 10% as well. People just don't know which direction it's going to go. What's the call that you are taking at Roha Asset Managers now, and how are you deploying the money that you have?
Hi, good morning. I would like to start by stating that we are living in an extremely high volatile market environment, no doubt, and that should be treated as an opportunity for investors. Now, clearly, equity market volatility over the last few months has got exaggerated by weak global noise such as inflation scare, much rumored US recession, Europe energy crisis, and of late even extreme volatility in the currency markets. Now the turmoil in Europe will continue, driven primarily by uncertainty on energy issues, while the US may not outperform the way it did in the past decade. Chinese economy is expected to grow at just over 3% this year, as per recent IMF forecast, due to its zero COVID policy and crackdown on excessive real estate lending. So what is left? So when we look at India, we continue to believe that domestic growth should withstand global concerns, and markets will brace this volatility or weak sentiments and eventually climb wall of worries despite currency depreciation. And there are plenty of reasons to briefly highlight. One is that there is broad-based earnings recovery. This will be led by private banks or financials, industrials and capital goods, and autos. A real estate cycle also remains robust with reduced unsold inventory levels, which is reflected in strong pre-sales and better cash flows. There is no material impact of even rate hikes on demand for home loans. Even in the first 5 months of current fiscal, home loan outstanding of banks has actually registered double-digit growth rate despite RBI raising interest rates. Second is, if you look at the consumption demand, it has exceeded even pre-COVID levels and one of the best in many years. Segments like travel, hotels, restaurants are doing best business activity. Consumption demand in apparel, appliances or white goods, footwear, jewelry sales are all witnessing massive recovery at the retail level. E-commerce firms alone have estimated to garner sales worth $12 billion during the 9-day Navaratri festive season that just got concluded. Even autos, whether it is two-wheelers, electric side, cars, commercial vehicles or tractor sales are all showing strong momentum. So barring cement and FMCG where margins can hit a bottom in second quarter, or the metal sector, most of the other sectors should report strong earnings.
Conditions, for instance, they have to have a minimum net owned fund of at least 1,000 crores. They should have a board approved policy for taking up the role of a resolution applicant. And in the case of a specific corporate insolvency process, ARCs cannot retain any significant influence or control after 5 years from the date of approval of the resolution plan and make more disclosure with respect to the assets they've acquired under IBC, among other conditions. The second important change is that the minimum net owned fund requirement that has increased from 100 crores currently to 300 crores, but this will be done in a phased manner by 2026. Third, ARCs will, by transferring funds, invest in the security receipts at a minimum of either 15% of the transferor's investment in the SR or 2.5% of the total SRs that are issued, whichever is higher on an ongoing basis. Number 4, the management fee or incentives which are charged towards the reconstruction or securitization activity can now only come from the recovery effected from the underlying financial assets. Number 5, there are several changes with respect to governance where, for instance, the chair of the board will have to be an independent director. The tenure of the MD, CEO and whole-time directors cannot be more than 5 years at a time. They will, of course, be eligible for reappointment and they cannot continue beyond the age of 70 years. There will be fit and proper criteria that will be applied as well. Other than this, settlement of dues by borrowers, which we often see under one-time settlement, can be done by ARCs only after the proposal is examined by an independent advisory committee. And this settlement should only be done after all possible steps for recovery have been exhausted. So these are some of the key changes that have been brought about for ARCs.
All right, Ritu, thanks a lot for taking us through all of the details and this modified regulatory framework for ARCs. But with that, we're going to wind down on this edition of Trading Hour. The market has actually moved up right now, so it's around 0.4% higher, around 70 points higher on the Nifty. And some of the FMCG stocks have really perked up. So take a look at Tata Consumer, ITC, HUL. If you take a look at the chart, you can see that there's been a sudden spike in the past few minutes, and that is also helping the market and giving it some kind of support. But with that, we're going to wind down. Thanks a lot for tuning into Trading Hour, and Halftime Report will take all of this action forward.